What if I told you that the stock market is about to have extreme volatility, but it's about to do something that surprises nearly every investor? Well, in this video, I interview an investor and macroeconomist named Henrik Zeberg that has decades of experience, and we talk about what is about to happen in the stock market and global financial markets around the world, and subsequently what is going to happen after this big event occurs. To learn everything about the complete context and to understand why this is all going to happen, make sure to watch all the way to the end of the video and let me know your thoughts down in the comments section below. Thanks so much. Let's go ahead and dive in. All right, Henrik, thank you so much for hopping on. If you could give everyone just a quick history, background, pretty much why you're credible to talk about financial markets, the economy, and where things are potentially heading.
Yeah, sure. So thanks, first of all, for having me on. Well, I'm a macroeconomist of background from the University of Copenhagen. And well, I think, ever since I graduated there, I've had a strong interest in macroeconomics. But obviously, one of the main drivers of my interest that got me going on this was really the financial crisis, where we had where we simply saw everybody not seeing, or at least a lot of analysts and banks didn't see this, huge crisis. And I kind of asked myself, how could it be that nobody really saw this and you just went over the cliff without anybody seeing it? And then I started to dive into, both theoretical approaches and technical approaches and more, just the old-fashioned economic approaches on things. And I built my own model on this, and in terms of how can you actually look at the model look at the economy and the markets in a more technical, structural, and psychological ways, meaning that you are using the dynamics of the crowds and the psychology of the crowd. And there I found Elliott Wave as one of the tools that could be very useful. Is being utilized very, very poorly by a lot of people. And what I built is literally hundreds of charts that are interlinked and entwined with each other and support the narrative and the targets that I have. So this is what I've done. And over the last almost 3 years now, we built the Zeberg report, where every week we have a live show, and we also send out videos on where do we see the economy heading and also the markets heading. So that's my background.
Awesome. Yeah, and you have a really interesting view. That's primarily why I wanted to bring you on here, because everyone believes, or at least it seems like everyone believes, that the market is heading a lot lower. People talking about another 2008, 2000 type scenario where we go down 40, 50, 60%. And right now we're not anywhere close. That's pretty much implying people believe we're heading another 30% lower from where we're at right now. But you have an interesting approach and thought process around where we're at. I guess what would be good is, can you catch us up on what's been happening just on a high level and maybe some key metrics on like what has happened over the past couple of years? Because, that we had a really long bull market, then we had a pandemic that caused a lot of hysteria, and then we had a massive amount of money being printed, and then a huge rally in stocks. And now we're starting to see that correction happen. So if you could maybe give the audience just an overview of like what you've been seeing in the economy and in the markets, and then where you see that heading. And then we'll go into why after that.
Absolutely. So I actually think you need to wind a little further back. You need to wind back until the financial crisis. And actually, we have to understand we never really got out of the financial crisis. And there are a lot of evidence to that. If you look at the charts from Europe, you'll see that they just went down, and then they've been flat for a certain amount of years, and they're going to go even lower. So let me just be very clear on this. I mean, I predict a deflationary bust, which is larger than anything we have seen since the great crash of 1929. So I'm not in the boat of saying things are just being fine from here and they're going to go up for years to come. What I'm suggesting is that we're going to see a blow off top. And the thing is, this is based on structures mainly, first of all, as I said, hundreds of charts telling me that we have another move up in the market. And this can be seen most explicitly in the emerging market. It can be seen in small caps and so on and so forth. So I'm absolutely with people saying we're going to go a lot lower, but the thing is we're going to go higher first. And the reason for that is simply that this great cycle that we started off in 2008 when the Fed went in with all the geniuses that went in and started printing money and thinking we can just create wealth out of thin air, has not come full cycle yet. We're not at that point. That's what the charts are telling me. That's the psychology of the market that tells me that. So when I look at it, what we see right now is everybody being in the boat, say, okay, this is the big one. And I actually got fooled also. I thought the big one was during the Corona crisis. I have to admit that. I thought that this is going to be the big one. It didn't really suit my charts, but I said, I think this could be the big one. And then we saw, the Fed and everybody moved in. And what they did was that they treated a supply crisis as a demand crisis, which then caused a huge spike in inflation. Because obviously, when you just add in stimulus across the world, every government around the world, administration were sending in stimulus money, and the Feds and central banks around the world did so, while the supply chain were breaking down because of COVID. Well, what you're going to get is an imbalance between supply and demand, and then you're going to get inflation. I did see that, but I did not see it move as high as it did. And that's why I've been saying for some time, I said, we're going to see a market bounce here, because I actually, before some months ago, actually, I said I could see that we were going to get another move higher. So yes, I hear people saying this is the big thing and this is the one thing. But what they really miss is that, first of all, markets topped, the NASDAQ topped in November of last year. S&P topped in January of this year. So we are talking about 11 to a little more than 12 months now where the top has been in, so as it seems. But if you look across the globe, you actually see that this is not supported by any of the large indices around the world. You don't see it in the Nifty. It's just put in a new high. All-time high. You see Nikkei could be on the verge of that also. Again, if you look at it from a structural perspective, as I do, you look at the UK, the FTSE 100, closing in on a new all-time high as well. I say it has bottomed at that a few months ago, some weeks ago at least. I can't remember the chart right here, but it's also heading towards an all-time high. And isn't it funny that we actually are looking at a situation where the S&P normally would be supported by the rest of the world in that kind of top, if that was the top, and then we don't see it. And also, if we then look at the real economy, we look at the economy actually bouncing back. We had negative. We didn't have a recession because we never had the deflationary feedback loop in the economy in Q1 and Q2 of this year. But we had a slowdown because of the large inflation spike that came, because that hurts the consumers. But we never. But now we saw in Q3 that we had a 2.9% print on the U.S. growth of third quarter. So maybe this wasn't the one. Maybe, and then people say, yeah, but the markets are leading, the economy. That's correct, but that's what we have seen. But if you look at the ISM numbers now, and you look at the PMI numbers now, they are actually starting to improve. And we just got the numbers out of the Europe today, not in a recession. So I think people are front running this a little too quick, and that's actually exactly what I see in my charts. And then Raoul Pal has done some tremendous work on the liquidity side. And if you look at it, the Chinese credit cycle is actually turning up rather strongly right now, which leads global liquidity. So I think everything is in there now. You got the indices across the world are bounced hard and reached all-time highs. S&P and NASDAQ are the only ones that are lacking behind. Even the Dow has been up strongly. And you have the economy that has been slumping, now bouncing, and you got liquidity coming into the system, while you see rates and the dollar also, the rates have topped as I see it, and the dollar is going to correct down to around 94 or something like that in my structure. So I'm not too worried about this, what we see actually. And people that are saying that the crash is here now are only looking at two charts, and that's the S&P and the NASDAQ. And that will be this week, next week, or the week after, before Christmas. I think we're going to break that trend line that will bring a lot of people on the other side.
So what is let's talk about the melt up real quick before we go into the potential bust here.
Blow off. There's very
Blow
big
off.
difference. Yeah, big difference,
Okay.
because I think it's going to be.
Yeah, let's talk about
that.
that. Let's talk about what's the major difference there, and what do you consider a blow off to be?
I consider a blow off to be 3 to 6 months worth of very, very strong rallies. If you go in and do an S&P chart with 3 months candles on, you can see the difference between what you had before 2020 and then coming into the 2020, and that kind of move that we then had after the corona crisis and the stimulus. And I think the candles you're going to see in the next 3 to 6 months here are going to be even stronger. And you look at there, you actually got a nice picture of it right there. So if you look at, Petrocco back there, 2016, there you got the melt up, or actually back to the 2008, that's the melt up. And then you go to the corona crisis there, you got the, in 2020, then you got stronger candles. And the blow off will be even stronger candles than this. So this will be 3 to 6 months worth of very, very strong move in that final move up higher. And there is an Elliott wave count to that chart as you could as I could give you also. But so I think, and again, we have to look at the real economy. People are saying, oh yeah, but the economy is then bouncing and then Powell will be very hawkish. You know, first of all, Powell and the Fed are not leading the rates. The rates are being actually set by the market. The 2-year is what the Fed is pretty much following. And the 2-year and the rates are now in decline. And I think what we going to see now is the situation we had after 2018, where you also got a top in the rates. And we saw both rate coming down on bonds, soaring, while you also had the stock market soaring. And that is the setup I think we're seeing right now. And it's going to take a lot of people by surprise, but it will also be interesting to see that this would be the most anticipated recession and crash ever.
So obviously for prices to go up, the demand has to go up. So what do you think is the catalyst to investors putting large amounts of capital into stocks over the next 3 to 6 months? What is the catalyst? Is it the dollar? Is it the Fed? Is it people realizing that we're actually not in a recession? What do you think are the top three, or maybe you just have one?
No, but there's plenty. As I said, so first of all, the economy is not in a recession right now. That doesn't mean that it's not going to get into one, because we are, and that's again where I'd say this is a tricky game here, because we got the yield inversion are so strong that it calls for a recession. It's going to come. But if you look historically in that, you can have 14 to 26 months worth of time before you see that. So the move up in markets right here from this point on is going to be driven, first of all, by a dollar that is going, and I call that over the last few months here, that are going to be a top and it's going to come down rather strongly. And we're going to see the dollar come down to around 94 before we see an actual bottom in the dollar here. And not in a straight line, it's going to be in an A, B, and a C line. And we could be close to that B wave up. Which will probably also be the last move for crypto, then down before we see that move up. But the dollar is going to correct even further down to around 94. And that will be one of the drivers, because as it went up, it was tightening the financial conditions. A second thing is rates have topped. And this is where people, they do not understand business cycle, really. I have to say, I'm sorry about saying that, but that's the case. If we were in a bust, and if we were in a situation where the economy was really slumping, you would see rates come down. What we've seen now into the top of this is rate going up. And that means that there are two different types of corrections. If you have a real deflationary bust, you're going to see rate come down 100%. If you see it's a correction because inflation is too high, we may see exactly what we have seen. Rates have been going up for some time, which have put some constraints, or the consumers have been pulling back because they have been under pressure. But the moment rates are starting to roll over, and the business cycle is at that moment actually topping, then together with the dollar that is correcting, you're going to see a bounce and consumers coming back. And exactly that you've seen consumers starting actually had a bounce the last print. That's why the economy is going to bounce one last time. But the Titanic has hit the iceberg, the inflation iceberg. Doesn't mean it's sinking immediately. it means that it has been damaged sufficiently to go down, and it's going to be really bad, but the party will go on for a little while. And the party this time around is the blow-off top, which is called by the move in of liquidity coming in. If you have the liquidity, I got the chart. Actually, Raul Pal made some on his GMI report, really good work there. You can see clearly how the credit impulse is moving up, credit impulse is moving up, which drives global liquidity. So when you're asking me what is going to drive this up, it's going to be, first of all, people realize, oh, the economy is not in a recession. It's actually starting to move up again. And then you're going to see liquidity come back into the system. Rates are coming down, dollars coming down, inflation is coming down. Oh, things are not that bad. And I bet you in February, you're going to hear media say, hey, the Fed saved the day because they actually, killed the inflation. So this is the green light, and, you can move right in to stocks. And that's when the stock market has already moved up quite a lot. So I think people are misinterpreting the business cycle where we are at. We are not in the crash, because then rates would be completely different place, and we are not there where we are, but we are not in a new cycle upwards. That's not what I'm talking about. We are late cycle, but the liquidity will come in once more, and that's why I think FOMO will also be a huge part of this when it sets in.
So maybe we could talk about how big of this rally are you thinking here? Because if you're thinking blow off, is that would kind of imply new all-time highs for the S&P?
Absolutely.
Okay. How high are you thinking?
5,700 to 6,000, around that number. There is a Fibonacci extension line that I do, and that gives me 5,700 or up to 6,000 before the top is in. And I think the S&P and the Nasdaq are going to lag, which they already are, as we spoke of, the Nifty, the NetDAX, the FTSE 100, or the UK 100, all of these have already taken off. So I think we're going to see, and that's also actually what normally is seen, that the economy in Europe is going to slump first, and that's why we're also going to see the top in those indices first, and then we'll hear further months down the road. The US is going to dodge this one, and because the indices are still moving up, and that again will be the sign to get out of the markets. So, yeah, sorry.
You kind of talk about indices that lead the S&P. Which ones are the ones that typically lead the S&P 500?
No, but if you look at it, if you just plot the Nifty, the FTSE 100, the DAX, the S&P, and so on and so forth, you will actually see that all of those would either confirm or lead the S&P, and the S&P would, as a minimum, confirm the others. It doesn't actually ever lead them all the way. So if you plot those, you will actually see that. I did that on Twitter just today, and it's so funny, because why is it that we just look to the S&P? And why is it that people can't do this and say, okay, if the Nifty is going to put in a new high, how probable is it that one of the largest markets in the world, and also with the UK market and the DAX and so on, how can it be that they are actually moving up this high and this strong if the S&P is about to just decline from right here? So you do not have a confirmation of the top in the Nasdaq or in the S&P from earlier this year. You don't.
So let's maybe talk about the bust that you think is coming. So first of all, do you think inflation has hit a peak? Do you think CPI data that's coming out here shortly, I believe in 2 days, do you think that's going to be better or worse than what we're expecting?
I think we have peaked. Let me put it like this. What we do short term, whether we're going, because there's one thing I can see, that is, I think cryptos has another bottom. I think there's another low coming in crypto. And there has to be probably a reason or trigger for that. And that could be a bad, in brackets, a CPI number. Could be, could also be, and also I see a bounce in the dollar. There is divergences on the dollar, meaning that the dollar is going to bounce some, which could also be created by the CPI number. So we could see next week a higher inflation, or maybe just on what it was last month or something like that. But if you look at it, if you look at oil, if you look at nat gas, if you look at the commodities, in general, they put in major tops. And I don't think too many people actually realize how big a top this potentially is. We see that that oil is down around 40% from the top in March. We see NASDAQ has put in what I think is a large, what I call B top. We see wheat, we see corn, we see every commodity coming down. So I think we are, people are not really realizing how important it is that inflation comes down, because that's what's going to play in on rates. Rates play in on how much liquidity there'll be in the system, and that plays in on the equities. So for as long as the economy is not in a recession, which we're not, and not even Europe, for as long as that liquidity coming into the system like that, plus China with that liquidity surge you see there, and it's actually quite extraordinary chart from Raoul Pal there, that is going to create that blow-off top that my charts speak of.
So before we, if you have that chart too, feel free to share it if you want to. But as far as the recession goes, huge debate on what a recession actually is. Do you consider the 2 GDP quarters of that are declining, or do you consider a recession something else?
I use the NBER recession, and the thing is, there are 6 or 7 economists that sits down and look at this and say whether this is a recession or not. I mean, this about the 2 quarters is something that has been put up. It's a popular way of thinking, but the thing is, a recession is something where the economy starts to bite in on itself and kind of cannibalize on itself. And there's a negative going spiral in terms of the labor market. We have not seen that. We did not see that. The labor market has been consistently strong. Retail sales is strong. We have seen that with everything you can look at is strong. The only thing is that the GDP, but it makes sense, because when you saw, when so much consumption was pulled forward by the demand stimulus, of course, you're going to see a slowdown in the coming quarters after that. You can only buy so many televisions and cars and whatever have you, and you'll pull some, consumption forward and investment forwards. That's what was happened, with that. And of course, you're going to see that slowdown, but it just went down and just but you did not see the deflationary cycle in that. So people's definition of this is just being, I just look at it like this as 2 quarters and that's a recession, and that's because they were going to manipulate the numbers. No, they did not. This is actually the right definition of things. That is that there are economists sitting down and looking at this and say, okay, did we actually have something that was a recession here, those 2 quarters? For instance, you could also say that the recession, which it was called after the Corona crash, which was a recession because it did start to bite in on itself, and you did have a negative spiral on labor markets. That was important, and that was why that was labeled a recession, even though you did not have 2 quarters of print. You just had 2 months worth of negative prints. So, I mean, it's misunderstandings here that really are. So I don't. The recession we're going to see is definitely not going to be something that is nice when it hits. And you're not going to be in doubt when that hits, because the labor market is going to be hit rather dramatically, and you're going to see unemployment soar in 23 and 24, late 23 and late 24 into 24.
Got it. And right now, so if we were to go to the minimum kind of projection of at least what you're estimating, obviously nothing is ever guaranteed. It's just all our personal opinion. If we go to 5,800 on the S&P, which would be a 47.5% rally. What time are you thinking kind of over the next 6 months that happens?
Yes.
Okay. And then after
I know what you're thinking. And but then the way you look at the charts here, it seems like, wow, that could not happen. But if you look at it in other charts, if you look at it, for instance, in the emerging markets here, not just remembering from the top of my head, and you look at the move that you had in emerging markets in the last move up in 2008 into the top in 2006 and into 2008, you actually had a move something like, like this in emerging markets. So yes, I know it sounds like a lot. I can see that, but these are the Fibonacci extensions. I don't think a lot of people actually really understand, but the Fibonacci extensions gives us the levels that the market, reaches or could reach, and there is, for me, around 5,700 to 6,000. That's the level. Yeah.
Got it. And then after, let's say, we get over this course, we do top at 5,800 or 6,000. Where do you see us going after? And I'm assuming you see inflation obviously turning to deflation. let's talk about maybe like what after we top, what then happens to the market after that, in your opinion?
So absolutely, you're right on the inflation turning to deflation, because what people do not understand is that the major deflationary force that you got right now in the system is the huge amount of debt in the system. You got debt everywhere, and that puts a pressure on the economy, and that's why the economy doesn't thrive with that. We've seen this before. We saw that after the Second World War, where debt was, bloating or huge, and they had to do a monetary reset. We had the Bretton Woods and so on. And they got us out of that. And you saw the economy then start to flourish again. What we see this time around is something similar to that. But what I see that's going to happen is that deflation now will come out from the fact that every company has built capacity after the Corona crisis, because everybody was doing fantastically. They were doing, 120, 130% of their expected, what they were expecting to produce and sell in 2020 and 21. And this capacity still sits there, and nobody has really been laying off the people. That's why we also see the labor market is still strong as it is. But when the demand then is waning or pulling back, you're going to see that the supply has to come down again. And that's why you're going to get deflationary forces from that. You're going to see companies laying off and so on and so forth. And that's going to turn into what I call the inflation deflation pendulum. So the further out it has swung to the one side, swings to one side, the further out it's going to go to the other extreme as well, because that's how the dynamics of the economy is. So you're going to get a very, very strong deflationary force when things are going to be, when demand is being pulled back, and you're going to see the supply is going to be cut to meet the demand, which is at another level than weeks that was supposed to be the level that were the run level after 2021. So that's the deflationary bust impulse that they're going to come there, and that, in my charts, it's so visible. And there are so many charts that tells us that this is going to bring, for instance, copper. Dr. Copper is going to go to a lower level than we had in 2009. I mean, it's going to be a bust that's going to take us to levels lower than that. And that is, to me, very, very, and especially also emerging markets, very, very strong deflationary bust that will take us there. So they're going to do something about it. When I say they, it's the Fed and administrations and so on. There's going to be something about it, and they will try to. They're probably going to expand their balance sheet in the Fed to 30 trillion or something like that before we see the end of it.
So you believe we're going lower than 2008, 2009, or to the top of where we're at in 07, 08?
There are two levels here. Now, again, I do this from the top of my head, and I do this based on Fibonacci levels. But there is firstly there's a bottom that could be around 1800. And that's just where you have the bottom of 2016. So if you go down there, there is something around that level, because that's a major. But sometimes you'll also see that the big consolidation pattern that you have from 2000 and into 2009, which is actually an A, B, and a C. You have it just outside of the picture here. That's a box, and that's a very huge consolidation pattern you got right there. And sometimes you see that you go all the way down there to meet that. So I would say the full extent of not just the deflationary part of it, but the deflation plus the stagflation that is going to set in after is going to reach at least 1800 is what I see, potentially around the top of these two spikes from 2000 and 2007.
Got it. So you're thinking at least a 70% decline from the blow off up here.
Yes.
Yeah, that would be pretty nuts.
Do you see
any assets doing well, whether that be commodities, precious metals, the dollar? Do you see anything actually performing well during that period of time?
You have to divide it into the phases that's going to go through, because again, you have to consider that the first part of it will be a deflationary part. That is when the rates are coming down strongly. And that's when the Feds will move in, or the central banks will move in, and they'll try to, put rate or get rates lower. So you're going to see that part is going to be deflationary, meaning that TLTs, bonds from all around the world. I think European bonds are a steal at these levels, and the same goes for TLT right now, because I see that the rates have topped already, and they're going to do tremendously well over the next coming, let's say, 6 months. And also into the phase of the deflation that's going to last maybe into end of 23. But after that, and during the stagflationary phase, and that will be the moment when the Fed again will move in and try to support this and stimulate this with huge amounts of liquidity. You're going to see that. I think we're going to see a stagflationary phase, and that will mean real stagflation this time around, not like what people thought was stagflation. And that means gold, silver at that point, not into the deflationary phase, because it's going to really tremendously bad during the deflationary phase, but coming into the stagflation of that crisis, then you're going to see gold, silver, precious metals, commodities do tremendously well. So there will be for now, as I see it, the blow off top, it will be equities. There are going to be and also bonds, but I think equities will outperform bonds for now. Then you'll see bonds for a certain period into 2023. And then you'll see when the Fed moves back in, like in 2008, actually. What you saw there was that the Fed moved in October after Lehman Brothers, and they started the money printing. And what you saw there, you saw that the GDX, you saw gold and silver taking off at that point, not during the deflationary phase of it. So and equities then just didn't bounce before March of 2009. So what you will see is that the disconnect between when the Fed moves and when the economy actually then reaches bottom will be extended this time around, because the economy is a super tanker. And the Fed will try to move in and try to make it move like a speedboat, but they are going to do some damage to it, because the financial market will take this in, and that'll be seen as inflation, and that'll be a new inflationary cycle coming. But the bottom in the stock market will be further out. I don't see that before 24 or something like that.
So the transition from the deflationary period, how long do you think the deflation lasts? Do you think that's maybe about a year?
So first of all, we have had a deflationary phase ever since Volcker killed inflation in 1982, not 81. So you actually had rates coming down all through that period. Maybe not in a straight line, but they've been coming down. And then people say, yeah, but rates are up now. But of course, it's not felt like deflation, but it's been deflation in the system. And that's why the debt has been building up. When you're asking me about it, just to be clear on that, because that is also a type of deflation. But if you look at the real deflationary bust that I'm talking about, then I think it's going to last from, my thinking is from March, could be Q1 or Q2 of 23 and into late 23. It will not be years. Could be 6 months. It could be 9 months. Of course, this is, people think inflation is the worst thing. If Fed had to, with gun to their head, would have to choose between inflation and deflation, they would choose inflation. They would have that rather than they will have deflation. And that's why they will not sit by idle and look at it and just say, okay, we'll just let everything sink in, because that's tremendously much worse than inflation. So they're going to do it. And they're going to move in really, really hard, because with the things that I see in terms of the liquidity and in terms of the value destruction you're going to see in certain markets, and you're going to see pension funds come under tremendous amount of pressure, and you're going to see bailouts of pension funds. Then you got to have the Fed move back in and provide liquidity.
And then what are you thinking about this stagflation phase? How long is that lasting?
But that's the difficult one. But I have to, I don't know, sometime into 24. It depends again on how long you're going to see, but that's a difficult one. There are more like the levels that needs to be reached in terms of the stock market, in terms of TLTs also, and the like. So there are many indicators of when that could end, but it's a little further out now. We need to see that blow off top. We need to see that the economy rolls over, and then we'll see how long. But the stagflation is going to be where a lot of corporations are going to have, pension funds are going to have problems, because where do you go? You don't go in bonds, you don't go in equities, and then they'll have problems because, if the market just keeps crashing and they have a lot of liabilities. So there will be a lot of problems when real stagflation plays out in 2023 into 24.
Got it. And a lot of people on my channel and following like to hear about crypto as well. What do you think that what do you think will happen to crypto over these periods that we've just kind of mentioned? And just a high level would be great.
but the so crypto, first of all, and I'll say this, I think crypto in general, 99.9% of cryptos are digital tulips. I need to say that it is. Mm-hmm. They are non-yielding assets, so they will move like with and I said this last year also in September, and I was, you could look at on Twitter and see how people didn't like that. I said we're going to see a much lower level coming to Bitcoin. I think Bitcoin, first of all, and Bitcoin and crypto are going to have another low, first of all, but I think we're getting very, very close to it. And I think the low could be down around at the 12,000 level, 11,000 for Bitcoin. Mm-hmm. But of course, with a blow off top, you're going to see that crypto and Bitcoin coming up rather strongly. And that's because, again, liquidity coming in, FOMO coming in, I want to earn easy money comes in. But during the deflationary bust, you will not want to be in crypto. And during stagflation, you do not want to be in crypto. And I think that's where the crypto will come to. I mean, that the real cryptos that have a fundamental value, that has value to the business, to businesses, that will be utility, whatever. Yeah, exactly. Those will stand up, so to speak, will need to stand up. And those will be the ones that can be, long-term solutions can be built upon. That's why I'm saying 99.9, because there will be few that will be used for that. Crypto is it's a bubble. It's been a bubble, and it will continue to be, but it doesn't mean that the bubble has burst entirely just yet, because it depends on liquidity and the FOMO in the system. And I don't think that has come quite out just yet, because we're not at the end of the business cycle yet.
So a good thing to kind of understand is, like, as new data comes in to the market, to the economy, obviously any intelligent investor analyzes new data and is open to changing their thesis on the market or whatever asset they're talking about. So what type of data could come in that would say, hey, I actually am changing my thesis of this blow off and this bust that is coming? Is there like anything that you see that if that happens, XYZ happens, then I'm changing my mind about what I think?
First of all, I would say that if I don't see that coming, because my model is based on, as I said, hundreds of charts. That will require that hundreds of charts will need to change. So that means that the Dixie will need to change in terms of look. It'll mean that the commodities setup will need to change. It means that the equities, it means that Forex in general will need to change. But let's say that something should change dramatically, that could. Then I would say, okay, that the Dixie has topped here, and I don't expect that. That is a top, and it'll go below 96. But then I would actually say that the chances of and I can't even say that because the yield inversion and all that, but I would say that the chances of we see something that the economy is actually moving to the other side, to the upside now, is bigger at this point than it is that it moves to the downside. But I don't believe in that, because I believe in the yield curve, and I believe in the yield inversion that we see. So it could be that the dollar weakens from here, and we see that gold and commodities actually start to move up instead of that move down that I see, and that would challenge it. But in terms of the bust, or in terms of the crash right now, right here, I mean. We should look at this the liquidity chart where Alpal did. I mean, there is.
Yeah, you want to pull that up?
Yeah, sure, I can do that. But let me just see if I can get that here.
So you're pretty much saying the bust is happening no matter what. Are you saying that there is a potential that the blow off does not happen, or do you think that's very, very minimal?
I perceive it as very minimal. Let me just see how I can pull it up here. Share screen. Let me see what I get here right here. Oh, there we go. Sure. So this is Raoul Pals, and I need to say GMI, global macro investor. So this is not my work, and it's something I get this report, and it's free on LinkedIn where I got it from. So it's but if you look at what you look at here, let me just go up first, and we look at the China credit impulse 5-month lead, and we got the global M2 year on year here. And what you see is that there is a lead on the credit impulse cycle here from China on the global M2. And if you look at it also in terms of the PMIs, then you got also that it leads the Chinese credit impulse leads the global PMIs, and this actually plays right into my scenario of there's going to be a bounce, and there's going to be liquidity for it. So I think if I can share another one here, and I'm not sure if I can. Let me just see if I can do that. But we don't have time for that, but let me just show the emerging markets here, and then say what I think is maybe the most important chart that you got that's out there right now.
Yeah, is there any chance that this happens in other markets but not in the S&P?
No.
Okay.
No. This is about the US with disconnect, and then I simply do not believe in that. I mean, we've heard that many times before that okay, this time it doesn't go to the S&P, and it just doesn't happen like that. It always happens also in. Let me see if I can just stop.
You may have to stop and then start.
Yeah, and then just do another one share here, and then we look at this one. And there may be that people do not, like this with Elliott waves and things like that, and they have to probably understand that this is not just about one chart. But as I said, we have something that has been going on ever since the 2009 crisis, or the financial crisis, and we see how that we had a decline here into what I call the wave A. We've seen that we moved sideways for a number of years here, which is not getting out of the crisis. This is just coping in the crisis. All Elliott wavers know that a big corrections comes in A, B's, and C's. And for a long time, as I said, I thought that was the bottom. It didn't really suit my chart here. It didn't look nice. But when I then saw that we did start to move up like this, I said, wow, this is actually a rising wedge you got right here. And it is just a rising wedge. It just needs to come together, these two lines here. So what you got here is actually a setup where A was the financial crisis, and then you had a long time frame here where they kicked the can for a whole long time, with liquidity coming into the system. And it now seems that liquidity is coming back in again. And look at this, we had a surge here on 14% on emerging markets just in November. And I'm saying and this I put in months ago, really, with this move up here. And I say we're going to see a strong move up coming up to this. When is it going to happen? Well, it can be Q1, Q2 of 2003, but the move and the bigger move here, and we also need to look at the divergence here. So this top you have right here is at a higher top of the RSI, lower top, and I'm then expecting a lower top here as well, that this sets us up for a major crash. This is not just in the emerging market, we look at this. But if you think about the narrative here, you think about the dollar coming down, you think about rates topping out, you think about everybody being negative already in the market, actually getting, and that would never happen like that. Everybody would not get that the market is crashing. And you see the PMIs coming up with liquidity, you would see exactly this. And then everybody will start to feel, oh, wow, we dodged a bullet, and we're now going to move in. And that, according to this pattern here, will then set us up for that major financial bust. And that's this move here, which is A, and then you had a long B, and you have a C. This to me is a very, very clear picture. And I know for people who doesn't study this, they probably think that's just like looking into tea leaves. I know that, but this makes a lot of sense to me. And this bust is going to be, worse recession that we've seen in 2007 to 2009. And
what would you say to someone that's maybe like a longer term investor? Do you think that, is that bust that you're talking about, is that like a reset of fiat currencies? Is that just a massive meltdown in equities and bonds and commodities? Or is this something to actually be worried about, in your opinion, if you're just a long-term buy and hold DCA type investor?
people can buy and hold if they've got a long time, but we also have to remember that after the 2009, the 1929 crash, that it took like, I can't remember, was it 20 some years before you got back to the level. So we have to understand that the bust of certain indices here and equities here can take you back a lot of time. And most people would not have that kind of time. And that's why I think also that this can be very devastating to people that hold equities going into this bust. And they will probably, and that's what you see often, is that they get lured into getting, oh, we got to get back into the market now. And this is not what they have now. Everybody's out. Everybody's, yeah, we have a lot of cash on the sidelines. We're expecting this crash. And then when it starts to move up, boom, they get caught by this, the whipsaw of this. So no, I would not recommend anybody just to sit and wait this out, because they could take a long time coming back from this. And it would be required, and you could not even just hide in bonds, because if you have a stagflationary phase, which I could bore you with another day why I see that, that's not going to be good for bonds either. So you're going to see pension funds really having problem there. Where they're going to be, and savers going to have problems. So this one is one that is going to be really devastating in many ways, also societal. You get inflation moving when you get the stagflationary phase, you're going to get unemployment coming up. That's what I mean, unemployment coming up, and you're going to see also prices starting to rise, inflation coming, and that is not going to bode any well for the political systems or anything like that. So I don't like what I see coming, going ahead. Would I hope I would be wrong? Yes, I would definitely, but I think it's going to be really, really bad. But not now, because everybody expects it, and the liquidity is coming back in. Stock market could be moving up, and the only two that we need to see this move on is the Nasdaq and the S&P.
Mm-hmm. Yeah, and I think from my point of view, I'm not going to go into my thoughts and everything, but I think it's when everyone is thinking that one thing is going to happen, such as us melting right now, oftentimes that one thing does not happen. And I'm sure in 2008, not everyone was thinking that we were heading for a 50% correction and a massive, destruction of some of the largest banks in the US. So I think that that's something that everyone kind of needs to think about. Let's say that someone has been watching this through the whole video, they've listened to you, but they still think you're an idiot for this call. What would you say that they are getting wrong? What do you think that they maybe have wrong in their head on why they think that you're incorrect? Obviously, you don't know exactly what they're thinking, but let's say they've listened to this. What do you think is the overall thing that it's not clicking in their head?
First of all, maybe that's a few things. Maybe just look outside the US and just do the analysis also on that. Then look and then say, okay, why is it that you got new all-time highs coming in certain indices? And then just think, would that really make sense? Then also look at the economy and actually look at why would the market crash if it's not in a recession. And then instead of just saying it's in a recession, it's just because they are manipulating the numbers. What if they are not? What if it is because it's actually not in a recession right now? And what happens normally when inflation comes down, if I'm right in inflation coming down from here? And then I think they should take a look at 2018, the 2000, actually not 2018, beginning of it, but late 2018 into 2019, where you actually saw exactly this kind of scenario that you have right now, where you saw rates coming down, you saw and equities moving up together with bonds moving up. And this is what we could have right now, right here. So I think they should just look at that and then just think and then say, yeah, just feeling the sentiment of this, and this is bad, because when it's the darkest, it's because the dawn is coming, right? And I think the thing is right now everybody's looking into this, that, oh, it's so dark out there and everybody can see this, you must be an idiot, why can't you see it? Of course I can, and I think it's going to be really bad. But the models just tell me it's not now. It's coming, but it's not now. And yeah, let's see 2023. I think when we get past Christmas, I think a lot of people will be actually on the other side of the boat, because I think Santa Claus is coming with vengeance this year.
Anything else you want to add that maybe I have not asked you that would be important to have context here, or anything else you think is important for the audience to hear?
Oh, wow. I don't know. I think it's I think it's about, adding up the full picture of this. I mean, the kind of work that I do is not just based on a few charts. And it definitely is not based on daily charts or minutes charts or 1 hour charts of as Elliott waves, because that's not the way to do it. And if you look at it in a bigger picture, where you look at the business cycles and you look at the charts and you look at, how do it all come together, then that puzzle, why is the butler the murderer? And you're asking that question and you find the different pieces of that. Then you can actually get to something which is another kind of conclusion than just having the sentiment out there. I don't know if that was different, but I think that is what is really important here, that people look at this in a bigger picture than just looking at 2 charts and a trend line of the S&P, which will be broken.
Awesome. And where can people find you to kind of follow what you're thinking on the day-to-day?
So I'm on Twitter at Henrik Zeberg, and we also have the Zeberg report where you can get in as a subscriber. You can get a trial phase there, and then I have a live show on Sundays where you will be able to ask questions and ask for charts that I can do analysis on. And also we have a community on Twitter where you can also ask questions during the week. And so that's where to find me. And I'm trying to answer as many questions as I can to the community.
Awesome. Thank you so much, Henrik, for hopping on, and really, really appreciate your insight.
Thank you very much for having me.
Yeah.